So hi everybody, my name is Joe Daniels. I'm with McCarter & English. Welcome to this Kiwi Tech Venture Capital panel. I am a partner and the co-chair of the Venture Capital and Emerging Companies practice at McCarter, so I'm just going to give you a little brief overview. So we've been around for about 175 years, so we're one of the oldest firms in America. We represent startup to Fortune 50 companies, and we have a department for everything that a business needs, right? Real estate, litigation, tax, et cetera, like every other big law firm. About 400 lawyers and 9 offices throughout North America. We've been representing founders forever, including Thomas Edison back in the day. I am personally head of this, what we think is a highly ranked venture capital emerging companies practice. We focus on formation, financing, growth, and exit. I usually work out of this office here in Manhattan, which I haven't seen for 6 months. Formation meaning, helping everything from one man with a business plan to a more established founder, serial entrepreneur team, raising angel and venture capital financing in successive rounds, helping that company grow through acquisitions and partnerships and commercial agreements of every type, all the way to international joint ventures, and then helping them exit through M&A or IPO. We're usually pretty well ranked in PitchBook, top 3 to 8 in our region, 6 to 10 in our nationally in the USA and globally, in terms of the number of angel VC deals we close every year for our clients. We represent thousands of venture funds and some of the more prolific people in New York, like FFEC, Differential, and Harlem Ventures, and even all the way out in LA, Level Up Ventures, who I think somebody from the panel from today. We did about 242 deals in 2019 for over $6 billion, about 141 for the first 8 months of this year for about $7.2 billion. And just so you know, we also have 120 IP lawyers, which are technical specialists in virtually every field, especially in tech and life sciences. And they handle the patent, trademark, and copyright prosecution, litigation, and licensing. We also have over 100 litigators ready to sue and defend over the USA when you get into trouble, or if you want to cause some trouble. I've been doing this for about 25 years. I basically joined the group that took Netscape public back in the day. And sold it to AOL. That was 8 years in the Valley. Here are some of the bigger companies I've represented, and venture funds and investment banks. I'm pretty familiar with the entire life cycle of startups, from creation to exit. And we usually focus in high tech sectors like tech and life sciences. I'm happy to help your startup with any matters that come up. So on our panel today, we have Joshua Siegel from Acronym Venture Capital. He is based out of New York. I think he might be in Florida today. Saad Siddiqui of Telstra Ventures. Saad, are you in Palo Alto or the Valley?
I'm typically based in San Francisco, yes.
Okay, nice. How's that looking these days, San Francisco?
It's getting better from a smoke perspective, but it just kind of comes and goes, honestly.
Yeah. Okay. Mel, I don't see your video from Dream Adventures, also in New York, I think.
Yes, actually I'm out of Philadelphia. My video is turned on.
Oh, there you are. I see you now.
Yeah, all right.
And Brandon, out in Los Angeles?
Yep.
All right, well, let's just kick off the panel. I will stop sharing. And let's just have everybody talk about themselves and their fund, and a little bit about what their fund is interested in typically, so we understand those basic parameters. Brandon, you want to start?
Sure. So Brandon Meyer, founder of Level Up Ventures, also previous founder of Quake Capital, have 150 plus pre-seed to seed investments under the belt, and we focus on industry agnostic companies. We're still actually actively raising our fund, but looking to start deploying in 2021.
Okay, Mel, you want to kick it off?
Yeah, sure. So I'm Mel Shakir. I'm the managing director at Dream Adventures. We are Philadelphia based. We focus on investing in early stage companies, so pre-seed, seed, all the way up to Series A. We focus primarily on health tech and secure tech verticals. Secure tech actually includes cybersecurity, risk and compliance, fraud, and even physical security. My focus area is primarily secure tech because that's my background in cybersecurity for many years. So that's a quick introduction of DreamIt. As a fund, we are on Fund 3, and in the portfolio, we have about 350 companies, 120 plus are mostly health tech. In secure tech, we have about 21 companies, and every year we bring in about 10 to 12 companies. That's our goal.
Okay, so and you don't only invest in the companies that have gone through the accelerator. You're completely.
That is accurate. So at DreamIt, we used to be an accelerator long ago, but we are more of a VC today, and we've retained some characteristics of the accelerator. We refer to it as a growth program. So we are very selective about bringing in companies because that growth program is only for companies that we're actively looking to invest in. Economics are VC economics, not accelerator economics.
Got it. Okay, Saad?
Hey guys, great. Thanks a lot for having me on the panel here. So I'm a principal at Telstra Ventures, and Telstra Ventures is a roughly $565 million assets under management venture capital firm. We typically focus on Series Bs and Cs and write checks anywhere from 5 to 15 million. We've got a pretty globally distributed team here in San Francisco, in addition to our team in China and Australia. And we've been around for about 8 years, and in that time, we've actually invested in 70 companies, have had about 24 exits, which include 3 decacorns, and these are companies like CrowdStrike, DocuSign, Box, Snapchat, and a handful of other unicorns as well. One of the things I'm actually proudest of in our practice is that we've actually generated north of $250 million in revenue for our portfolio through a bunch of our partners. And from a focus area perspective, we span primarily enterprise and consumer. And I typically spend a lot of my time on infrastructure technologies like artificial intelligence infrastructure and security and network infrastructure. Nice.
Do you invest in non-synergistic businesses, or is it like the only things that Telstra has synergy with?
So we're independent as of 2 years ago. So we took some outside capital from HarborVest, and Telstra is still a pretty valuable LP of ours. And so we end up doing things that are independent of Telstra's priorities, but at the same time, our value to our LPs is the fact that we can help accelerate their businesses for the long term.
Got it. Joshua, last but not least.
Hey, Joe, thanks for having me, and Kiwitech as well. I'm Joshua Siegel. I'm the founding general partner for Acronym Venture Capital, which is really an outgrowth of my previous fund, which is Rubicon Venture Capital. We're a $40 million fund. We're starting off as a new baseline fund this year. And so we do mostly late seed Series A investments into 6 primary areas: enterprise software for fintech, hospitality tech, real estate tech, workflow tech, and e-commerce infrastructure. And then we do omni-channel food and beverage brands. So typically we'll get involved when companies are doing anywhere from 1 to 2 million in actual recurring revenue. And we're considered a value add firm. So a lot of the best VCs really do help the companies. We do it mostly on a revenue generation capabilities, much like Telstra and some of the other VCs. And so we really like to get involved on that basis. We will lead rounds, but we also just participate as part of a syndicate with a lot of the other New York-based VCs. I personally now am based down in the Palm Beach area due to COVID, but we're very much a New York firm, so that's where we do most of our deals.
Excellent. Okay, thanks for everybody for the intros. Why don't we get warmed up a little by talking about some macro trends? So I checked out the latest, the Q2 PwC Money Tree report. It showed Q2 2020 VC investment was down about 1% compared to Q1 2020, but it was down 18% year over year versus Q2 2019, which sort of reflects a ticking downward in the total dollars invested since 2018. IPOs were up to 24 versus 15 in Q1. So sort of an IPO, a little mini boom. And then M&A fell to 120 deals in Q2 versus 155 in Q1. So funding was a bit down, but maybe not as much as you'd expect with COVID-19. And while M&A definitely slowed down, and IPOs were actually up, and that's all consistent with what I'm seeing. Like my business is pretty much, I mean, actually it's sort of increased by 40% when you include health tech and all that other stuff. So that is affected by COVID. So what do you guys think the trends are in venture right now, each of you, especially due to COVID-19, and where are we going in Q4? Why don't we start with Joshua?
So I definitely think there has been a pause overall for the year, definitely in Q2 and a good part of Q3. And that's a natural sort of reaction to what's going on with COVID because people want to see what's going on with businesses. But it really depends on the industry area. So we don't really do healthcare tech. We have one healthcare tech deal in our past portfolios, but we don't really do that. But there's a lot of funding into healthcare, a lot of funding into ed tech and things of that nature, whereas some of the areas that we're involved with have slowed down a bit. So some of our companies did raise significant amounts of funding, but other companies did not. So I think it's much more reactionary. The key is there is plenty of dry powder. There is a lot of money sitting in venture capitalists' hands, and we are simply waiting. We don't need to rush into a deal. We want to see how people are going to spend the money. So I think there's going to be a substantial rebound into 2021. I don't see this as a fundamental shift in VC deployment overall as an industry.
Okay, Mel, what do you think?
Yeah, I think I would concur with Joshua, and especially the two areas that we are focused on, health tech and secure tech. We haven't seen any dramatic slowdown as such. So we are actively funding, health tech companies. We're actively funding security companies, and the partners that we're working with. We typically work as a syndicate because we follow rounds. They are all investing, and as Joshua mentioned, there's plenty of dry powder. The funds were raised prior to COVID, so the money is there for deployment. But yes, everybody is being a little bit more careful. So in terms of, for what it means really for startups is that there might be less favorable terms, right? Because the risk is definitely higher for investors.
So
Yeah, I think from at the stage that we typically focus on, we're seeing in some ways a tale of two cities where I think the companies that were sort of in second or third place are having a harder time raising, where companies that are the leading firms are raising tremendous capital at tremendous valuations. And they're sort of garnering a ton of venture capital dollars at incredibly favorable terms. And in a bunch of cases, we're seeing businesses accelerate during this time. So as an example, one of my portfolio companies provides the network infrastructure through which everyone basically streams a bunch of content at home. So you would not be able to watch your favorite shows on a bunch of these like streaming sites without their technology. So their business is booming in a big way. Gaming has become a pretty big area as well, as people sort of sit at home and play more video games. So businesses like that are accelerating in a big way. So we're seeing a tremendous amount of venture dollars flowing in those industries as well. While other verticals, like things sort of catering to hospitality or travel are definitely sort of getting a brunt of things, although we're sort of starting to see a lot of that come back.
Yeah, I see the same. Brandon, what do you think? Any trends?
Yeah, I think a lot of what's being seen was mentioned, but yeah, there was a real slowdown kind of second and third quarter, especially with pre-seed and much earlier stage companies. There's definitely certain industries. I worked with a restaurant app that business is booming, and so there's certain industries where it could be directly affected by COVID, why they're shooting up, and there's still some apprehensiveness in terms of like investing in those and seeing how that might maintain, like whether it's going to maintain a status quo or it's going to it's going to have a dip. Yeah, seeing a lot of slowdown on certain investments, starting to see a pickup as we're getting towards the end of the year from an early stage front. And it looks like it's going to be booming in 2021 because there's a lot of undeployed capital that no one's going to give back to their LPs.
All right. Well, let's hope there isn't some kind of a second wave, and all those optimistic characterizations are all correct. I sort of agree with the whole thing. So, an important question for all the entrepreneurs, founders in the audience: what are the operational milestones or other characteristics? What do companies need to reach for the funding level that you participate? I know many of you talked about pre-seed all the way up to the A round, but if you're more focused on the B round, then talk about what the sweet spots you want to talk about. And is it a certain team, revenue run rate, whatever, even geographical proximity, stuff like that. Brandon, you want to start with that?
Sure. I think, when you're dealing with early stage, and I know it's different kind of the board of this panel, but when you're dealing with early stage companies, a lot of it's looking at what type of market validation they have. And then it really comes down to the team. If this is the team that's going to lead it forward early on, if they have the type of relationships and business acumen to kind of get through those first couple of rounds and take it to the next stage.
Anybody else jump in?
So I would say, for us, we have a very specific thesis approach for how we invest in companies. It's not theme related, which is very different. We like to have certain numbers and certain characteristics when we're looking at a company. So if we're looking at a company that we define in the late seed, and it's a software company, we really want the company to have about $1 million in actual reoccurring revenue, like real revenue, not just like one client that paid $100,000 one month and all of a sudden you're on $1 million run rate. That doesn't count. You have to have real clients. You have to have a real product market fit to a certain extent. And, we helped sort of coin this approach with the Superhuman team that we invested in very early, which taught us years and years and years ago why we don't invest that early. But it's very important to have that revenue. It's very important to have a good, solid team. You don't have to have everybody, but you definitely have to have your technical team in place and your sales team in place. So that's very important. And you got to have your product market fit, right? You got to know your customers, identify who they are, if not by actual name, then by industry profile or who the buyer is in any particular company. So we want to see those things, right? And you have to be raising for at least 18 to 24 months of operational runway. And that part is really important because anything that can happen will happen. COVID is a great example of that. While nobody was prepared for COVID, a lot of us in the VC community are prepared for recessionary environments. And so this just sort of, accelerated that. So those are just a couple of things that we like to see in our companies when we're doing our analysis and having everything come through our funnel.
Mel?
I think from our perspective, one thing that we've sort of noticed is up until early 2019, the thing that sort of paid the bills and helped you raise capital was revenue growth. I think there is now a tremendous amount of focus on unit economics and making sure that on a unit basis, the company is growing at a pretty efficient way. And if companies are able to do that on the mid to late stage side, they're commanding valuations anywhere from 50 times to 75 times, so even 100 times ARR. So we're seeing venture capitalists deploying more capital in some of these later stage companies that are growing in an efficient way and in a fast way as well.
Yeah, and one of the things that I'd like to add, right, is if it's a pre-seed company and it's pre-revenue, we'll still get in, but the bar is really high for those companies. So it has to be an exceptional team. But with any company, we'll always look, even in a pre-revenue stage, that are they working closely with design partners? Is the product close to MVP? Right? We want to be able to get some buyer insights from potential buyers, right? Without those, we are just aiming in the dark. So the bar is again very high for pre-seed companies. For seed companies, of course, there has to be customers. Again, the same need, right? That we need buyer insights. For Series A, yeah, they have to be close to $1 million ARR or a little bit upward. So I mean, those would be some of the basic stuff. But we are always, as far as I'm concerned in security, we're always looking for trending categories, where there's a lot of investor interest, where there's a lot of customer interest. And in the security world, especially due to some of the trends in digital transformation, we're seeing lots of different opportunities for security startups, especially related to cloud security and privacy and some of the other areas. So those are certainly higher interest as far as we're concerned.
Excellent. Thank you, everyone. So another important question for the entrepreneurs, founders, what's the best way for them to find the right VCs and get a meeting? How do they follow up after a meeting? How do they get a check? I mean, those are all the questions I'm sure they all want answered. Specifically, what kind of materials you want to see? Do you want a warm intro from somebody like me or Kiwi Tech, or just cold call emails, or spray and pray? We can start with anybody who wants to jump in.
I'll jump in on that to start. So there's basically 4 great ways to reach out to a VC. One is obviously through a warm introduction, through a connection like a law firm, an accounting firm, a banker, something like that. Another way is to reach out through an existing LP in the fund. That's going to be hard to find out, of course, because all LPs are confidential. But if you know someone that knows a VC fund, that's good. Knowing another VC that is connected to the VC you want to get to is a great way. But one of the best ways is actually going through our existing portfolio companies. So one of the challenges that people don't necessarily understand is that in venture capital, you have to manage your portfolio. And at any given firm, there's anywhere between 10 or 150 legacy portfolio companies. There's a lot. But when a founder emails you, the VC, that perks us up. Usually founders email us for money, right? Or if there's a problem, or if we have to chase them to get a report. So if a founder is emailing us out of the blue, we pay attention to it, right? And that's a great way to get your deck noticed, and you always have to have a deck. Don't email without a deck. It's a waste of everyone's time. But those are really some of the best ways to pique our interest. Like, we ignore stuff on LinkedIn. We certainly don't respond to anything on Facebook. So you could try out of the blue, but we can all be found, all of us, right? So find someone that knows us. You gotta use LinkedIn like the Bible, and you'll find us. And what you have to understand as well is that if we don't respond, that is a response. That may just be a no. So if someone sent me a biotech deal out of the blue, I don't have time for that, right? But if Joe sends me a deal, no matter what it is, I'm going to look at it.
Yeah, that's true. Pretty quickly too.
Yeah, that is definitely true for us as well. But one of the things I'd like to add, right, as far as startups are concerned, we actually take our startups through the art of prospecting for investors. We actually have a session for them, and we train them. And the whole idea is that it's an art, right? And you have to get it right. We assume that these are basic things that everybody would know, but it helps coming from VCs who have been through this. So aim for 50 to 100 prospective investors, right? Build that list. Categorize those list of VCs A, B, and C. And pitch first to the B list of investors, right? Get your pitch, fix your pitch, get it right. Use LinkedIn for warm intros. And then where are you going to get the referrals, right? We ask them to categorize that as well. There are some category of people that will give you unlimited intros, right? That may be in your first or second degree, but then there are some others that you can use sparingly. And then finally, we talk about the art of email ninja and how to write those emails and get a quick yes or a no, right? So it's a sprint, not a marathon. And you have to judiciously work through that list of 50 to 100 prospective investors. Another great way to do it is, join a program, right? Like incubator, accelerator, growth program, because all of these have connections with strategic VCs and strategic investors, right? That would be well aligned with you. So that's a great way for VCs for startups to get intros. Just to give you an example, right? At DreamIt, we have something called the Investor Sprint. And in a 2-week time frame, even now the one in COVID that we just finished in July, on an average, we got 30 meetings over a 2-week time frame with the investors. And investors, love to partner with other investors because, and ones like DreamIt, because we are looking to invest in those companies ourselves. And we won't be leading the rounds, so it's easy for us to build a syndicate We get a lot of traction that way. Startups get a lot of traction that way. And we have startups who finished in July who have already closed 3 million rounds, right? So it can be a very effective way.
Great advice. How about from Level Up?
Yeah, I was going to say for a lot of first-time founders, yeah, you don't have networks coming out. One thing I'm going to give a not to do is when you start getting out to events, which mostly are digital now, not looking at people as checks. Start building those relationships early on in your business, knowing that you need proper things like market validation, that you want to come as a sound founder to investors, like showing that you have a level of understanding, knowing what you're doing because you're asking people to write pretty large checks to you. In terms of building your list, both Crunchbase and LinkedIn can be super valuable. Crunchbase for looking at other, as you're exploring your competition or other similar investments in your space, when they're earlier investments, not necessarily that are directly competitive, but potentially complementary. You're going to find a lot of their early investors. It's a good way to find a lot of those early angel investors that aren't always typically listed. And then cross-referencing that list of 150 to 200 plus people or groups that you've put together, knowing that VCs out of that whole group of angels and incubators and accelerators are going to be the hardest ones to close. Something else to really keep in mind when you're going through this fundraising process is look at, you're running a business, so look at it like a business. A $5 million fund that cuts 50 to 100K checks, the reason why they're not going to give you a check necessarily first one in is they don't have enough, typically if they don't do follow-on investment, they don't have enough dry powder to protect you if you burn through that in a few months. So build your network, try to look for warm intros, use LinkedIn as much as possible as a cross-reference, and really get yourself out there having conversations. But anytime you can get an intro, go that route, because reaching out on LinkedIn or sending someone that you don't know that's a complete stranger 2-3 paragraph email is never going to get you a response.
Anything more to add, Saad?
Yeah, I think you guys kind of covered most of the main ways. I think the one other thing I would sort of add is as you're sort of getting introduced or reach out to investors, one thing that's always helpful is trying to look at the investor's previous track record and see if that's in line with the kind of business that you're looking to build. For example, I cover a lot of network infrastructure and data infrastructure. If someone reaches out to me with a biotech pitch, I don't know if I'll be able to help in a massive way. So just kind of like trying to understand like where someone is and what they sort of focus on is super helpful. In addition to that, what I sort of noticed is like, especially in COVID, there's a formation of consortiums that are becoming much more predominant from a way of funding perspective. People like doing deals with people that they've worked with in the past, and that's sort of in some ways, for good or for worse, accelerating. Deal flows are coming from previous round investors that those previous round investors have invested with in previous companies. So that's another way. But Joe, I think one thing I also wanted to kind of talk about was you asked a question around what are the ways that people get funded. I think from the way we sort of think about the market, and it's probably similar across most venture capital firms, and the emphasis varies on the venture capital firm. So the way we sort of think about it is the market and how big the market is and the different market dynamics around competitors and stuff. The second one is the team, primarily tied to the founder market fit, what specifically gives this founder insight into solving the problems in this industry. The third is technology, which is primarily tied to how deep is their moat and how much of a head start will they have against competitors that are in their space. And the fourth is business model innovation. This is honestly the hardest one to crack, but if people are able to crack that and are able to solve people's problems and deliver it in a way that is not delivered before, ends up being probably the biggest value accretion out of this. but depending on the investor you're talking to, they weigh these very differently. Also sort of like having that in the pitch decks is super helpful.
Absolutely. Got it. Okay, so we're running out of time, but I think we have time for one more question, and let's make it sort of a lightning round because we already talked. I think all of us have talked a little bit about, what sectors do you think are overhyped in venture right now, and what do you see as attractive, despite what the community says? Anybody, just jump in.
Or I'll speak to cybersecurity because that's my subject area of expertise. And
I think Palantir just listed today, for example.
I'm sorry, I still didn't get that. Again, my background is in cybersecurity. Over the last 5 years, coming up to 2019, that has been a very hot sector. It's been the #1 area in enterprise technology. So there are certainly hyped areas within cybersecurity, but we still see a lot of opportunity in cybersecurity. The only big concern for me is that there are a lot of Me Too companies with not enough competitive differentiation, going back to what Saad was referring to earlier. That is why we specifically look for competitive differentiation, and that differentiation can come in go-to-market models or any other way, right? Technology primarily. Other sectors, I don't pay that much attention, so I'll let the others take that.
Yeah, of course.
I would say
Yeah,
there
go ahead.
that we're seeing, like, definitely the mobility sector is very, very hyped up with a lot of things. Definitely overhyped on the scooter point and sort of the LiDAR companies and things of that nature. So there's definitely going to be a routing in that sector. And I definitely think in the food business. So we're in a couple of food companies. There's a lot of talk of ghost kitchens and a lot of direct-to-consumer stuff and things of that nature. And there's definitely opportunities there. Some have done very well, like HelloFresh. Blue Apron is having a bit of a rebound, although who knows how long that can last. And so there's a lot of hype in some of these things. But eventually, a lot of stuff will come back down to earth. COVID will probably be with us for a couple of years. We're starting to be able to manage it better because now people understand it and understand what to do with it, but it's definitely still going to have an effect. It's just a question of if that goes out 18 months, and everything starts to come back to normal, will a lot of these companies be able to get and keep their customer base, right? So you got to balance that as a VC and look to the future. Like we don't invest in a company looking for just 18 months. We look 5 years out, right? We want to know what's going to happen. Sometimes you're right, sometimes you're wrong.
Saad or Brandon, any idea about what's hot and what's not, or what should be hot and is not?
I think from my perspective, we do see a tremendous amount of customer demand on the data side of things. But at the same time, the amount of companies that are sort of coming up in this space is pretty mind-boggling. So from that perspective, the amount of effort that's being put on data analytics and also the amount of as data sort of grows is pretty impressive. But depending on which pocket of data infrastructure that you're spending time on, it could be overhyped or not. I think that's one area. I think that sort of bleeds into maybe some of the things that Mel sort of spends time on, which is around data privacy and security. We're seeing a combination of companies that are historically data cataloging companies sort of merge their capabilities with privacy companies. So we're seeing a melding of a couple of industries as market sizes aren't big enough for some of these things for independent companies. So I think so that's an example of pockets that don't have a tremendous amount of market size to go after, so they're kind of moving into other pockets. So just you have to be very careful when you're sort of selecting some of these companies here.
Okay, so some questions from the chat box. Just really quickly, does anybody invest in commercial blockchain companies or social impact companies?
No.
So we are not averse to that.
I thought that was going to be.
We don't invest in blockchain per se, but if it is used as part of a security solution, then it's fine. We just consider it as tech. We don't go specifically after blockchain companies per se.
Joshua, is your partner still into that, Andrew?
So he was into it for quite some time. Andrew now runs his own firm, 7VC, out of San Francisco, but he's really not doing blockchain, Bitcoin stuff anymore. I know too much about it to want to get involved, and it's just something I stay away from. I've no desire to be in that business.
Yeah, I think you made the right call there. Okay, so we have a lot of questions in the chat. We can't get to them all because I think we've run out of time. Karandeep, am I correct?
Yes, Joe.
Okay. So panelists, thank you very much for really precise, transparent answers. I think everybody appreciated that, and it's great to see you all. It was a fun little afternoon. Thanks again.
Thanks,
That's
Joe.
all I have.
Thanks all.